Good afternoon, everyone. My name is Jeffrey Scott, and I'm with New American Funding as a loan officer. I've been doing this for about 18 years. And what I'd like to do is just take a moment so I kind of have an understanding of where everyone's at in their career, if you would, so I could gauge where I should spend a little more time or a little less time. Possibly in chat, if you could let me know how many years you've been a realtor and if you're a new agent. Okay, anybody else that feels free to chime in, I'll adjust accordingly. I'd also like to encourage anyone that has questions as I go along to please feel free to ask those questions. I want to help, I want to be of value. I have an awful lot of knowledge on the process and I love sharing. And if I don't answer your questions online, you're free to email me or call me at any time. I'll give you my cell phone number at the end and you'll have complete access to me. So I thought I'd start off by first saying when I first got into the business, I was awfully intimidated by all of the jargon or the slang that was coming at me. For example, FICO score and reserves and DTI and LTV and CLTV and PITI or ITI and CTC and MOUSE is what I would throw at the end of that because it just, none of it made sense. And so what I thought I would do is take this class and break it down into the steps that occur, and then I can kind of describe to you what that is all about at the end of the day. I'm going to start off with a trivia question, which I think is kind of fun. And this is the question: how many people do you think it takes to fund a real estate transaction? And if you want to put that in the chat, go right ahead. How many total people do you think it takes to fund a real estate transaction? I see 10, 15. Yeah, you're pretty spot on right there. It's anywhere between 14 and 16, 17 people, total hands in the pie. And I'll kind of walk you through it. You have the loan officer assistant, you have a processor, you have a junior processor or a processor assistant, you have an underwriter, you have a escrow officer, and you might have a junior escrow officer. You're gonna have a title officer. We're gonna have an appraiser, but before I get to the appraiser, I've got to go through the appraisal management company. So there's another person. We have a fire insurance agent. We possibly have a condo association or a PUD association to deal with. We have a funder towards the end of the transaction. We have a notary involved. And we have the Orange County recording office involved. So it's our goal, of course, to organize all that and get it as streamlined as possible without missing a beat. But as you can see, with that many people involved, beats are missed often and can be, unless you're really conscientiously aware of where your loan is at every point in the transaction. Loans are not hard, honestly. People make it hard. They're really quite simple. So let's walk through the process of how a transaction occurs from start to finish. So first of all, there is the application or the loan application. In the old days, we called it a 1003, and I don't mean that really that old. It was a 1003 all the way up until 2021. And what occurred was that because of the 2007 and 2008 mortgage market meltdown, that is when we had the subprime lending that exploded and blew up on us. The laws that came out of that was to protect the consumer. And one of the things they did is they've changed the application, which was the old 1003, to something called a URLA, which is a universal loan application. And it's harder to read. It's lengthier. And Elsie, if you'd like to put a link in there just for people to see it. This is more like a 8 or 9 page document with, I mean, if you think we ask for a lot of information prior to this takes it one step further. But again, the goal was to protect the consumer, but what's come out of it is a pretty big headache for the consumer, quite honestly. This application generally in the old days, and I really mean prior to 2021, we could take these applications by hand. It was in 7 or 8 minutes. Today, it is done mainly online, and that has made it much easier for the consumer to go onto a link. We send them the link, and they can fill out all of their information, both the borrower, and if there's a co-borrower, such as a wife or a significant partner or brother, sister, whatever, they can fill out the application, their applications on the same loan application at the end of the day. So that kind of streamlines it and makes it a lot simpler. Once the application is completed, we'll move to the next step, and that is gathering the financial documents. And again, this is really easy. Now, people make it hard, but it's super easy because all the consumer or the borrower is doing is copying, or they are creating PDFs, getting PDFs off the website of their financial documents, or there's even a simpler way, and thanks to technology, when they are completing their loan application, there is an option to link your bank accounts to the application, as well as your pay stubs, because a lot of people get paid through ADP, or they get paid through Gusto, or they get paid through, there's 7 or 8 different systems. And if they link their bank statements or pay stubs to the actual application, then it's all done automatically, saving the borrower from either printing out documents and scanning them and sending them to us, or getting the PDFs off their website and scanning them, or just emailing them direct. So technology has taken it to a new level, making it super easy, particularly for a W-2 employee who gets 2 paychecks a month, or 4 paychecks a month, and it makes it super streamlined. He can link his Chase account, or his Bank of America account, or Citibank account, or Federal Credit Union account, whatever, and we can literally have the computers talk to each other and update themselves through the transaction, and we never bother the customer again. So again, it's super easy to do, but it has infuriated customers in the past when they have to update documents as the transaction goes on. So let's talk about the documents. There are 3 categories of documents. They're super simple. We're going to collect documents on the property in question. We're going to collect the asset statements or the bank statements, and then we're going to collect all the income statements. When we collect the customer's property documents, for example, if it's a purchase, which is what you'll be managing in most of your cases, we're going to get the residential purchase agreement. We're going to get the addendums, any disclosures. We're going to get all the counteroffers, every one of them, because that's very important. We'll need a copy of the earnest money deposit. We'll need to know who the title company is, the escrow company is. And with that, we're going to ask the consumer, and you keep this in the back of your mind because you'll want to prep them, have them start to think about a fire insurance policy quote. So you've got Farmers, Allstate, Geico, Progressive, State Farm. Those are the companies that they're going to need to get a quote. And they've never done this, not always, but in a lot of cases, they've never done this before. So prepping them to start to think about a fire insurance quote is something that helps them understand the process also. Then what we're going to do, if it's a refinance, which is what you won't be managing often, but the other documents that we would actually need would be a copy of this tax bill, a copy of the HOA statement, if applicable, the homeowners association statement, because that's another bill, and then a copy of the loan statement if the customer has a loan on the property, and most do. So there's basically, those are the property documents that will be collected for either a purchase or a refinance. Moving to the bank statements or the assets, there's two groups that I like to distinguish. There's your liquid assets, and then there's your non-liquid assets. So think of it as this: 60 days or 2 months of bank statements for your checking account, which is liquid, your savings account, which is liquid, and your money market account, which is a liquid account, meaning you can get to those funds immediately. Your non-liquid accounts, they're going to ask for 90 days of statements, but in a lot of cases, retirement accounts will come in a quarterly statement. So it's going to either be 3 months of statements, or it'll be one quarterly statement for your non-liquid accounts. So those are your IRAs, your SEP IRAs, your Roth IRAs, your pensions, anything that's designated as a retirement account. And retirement accounts can be liquidated, but they are not liquid, if that makes sense. So a retirement account actually has to be sold off and then transferred into a liquid account, and that could take up to a week actually. So those are your two groups of asset statements or bank statements. The next gathering of documents that we're going to gather are income documents, and just thought of something going back to the assets. The reason we look at assets is because we want to make sure that the customer either has enough money for the down payment and the closing costs, because those are two different things. The down payment is the customer's investment in the property. So that's like your 20% down, or if it's an FHA loan, you're 3.5% down. But then you have your we call them non-recurring closing costs or closing costs. So that's your title expense, your escrow expense, your notary, your appraisal, your underwriting, your processing, et cetera. We'll go into that later. But the reason the bank's looking at the assets is to confirm that they have enough money to close on the transaction. And they also, in some cases, want to see which are called reserves. And reserves might be 2 months of your bank statement, your tax payment, your HOA if you have one, and your fire insurance policy. It could be 4 months, it could be 6 months, it could be 12 months of reserves, it could be 18 months of reserves. And that's all dependent basically on the loan size. So the bigger you go up in loan size, the more risk it is to the lender for default, just more risk. Hence, they're going to ask for a greater number of reserves. And the idea for a reserve account is that in the event you lost your job, or there was a medical emergency, or something occurred and your pay stub, or you weren't working, and so you weren't generating new income, you would have these reserves to draw upon for 2 months, 4 months, 6 months, a year, whatever. So now I'm going to head back to the next section, which was income. The documents that we're going to request from the consumer or the borrower would be 30 days of pay stubs. So if you're paid 4 times a month, weekly, then that'd be 4 pay stubs. If you're paid once a month, that would be 1. And if you're paid twice a month, that's 2, but current. We're going to ask for 2 years of W-2s or 1099s. A W-2 is where a customer works for a corporation, and that corporation pays that customer the same on every paycheck. They're issued a W-2. If the customer was more of a salesperson, for example, realtors are a classic example, you're going to be paid on a 1099, and you'll be paid, that 1099 will come out at the end of the year or the beginning of the new year for the prior year. And we're going to ask for 2 years of 1099s. We're going to also ask for now not in all cases, but in a lot of cases, we'll ask for 2 years of tax returns, personal tax returns, which are called your 1040s. And I'm certain you're familiar with those because you file them every year. If you're self-employed and you have a corporation or an LLC of any sort, then you're going to have you will also have 2 years of business tax returns. And so those are called your 1120s if you're a corporation, or your 1065s if it's a limited liability partnership. And then finally, if you are also self-employed and own one of those entities, you will have a profit and loss statement and a balance sheet that would also need to be submitted to verify your income. Now, all those documents that we have just mentioned, like I said, it's super simple to collect. They're super simple to get. Now, yes, it does aggravate people, and it tries people's patience, but it's super simple. And so it's super easy to do. And what's happening is that we're getting those documents simply to verify that the numbers on those documents match the loan application itself. So it's a verification. It's like Reagan said to the Russians back when he was in the office, we trust but verify. So with that said, there's going to be a handful of other documents that keep these in the back of your mind because they do pop up. If the customer is pulling money out of a 401k at his company, there's going to be a 401k terms of withdrawal that we'll need to get. Most people are unfamiliar with that document, but it's going to be needed on every transaction that a customer pulls money out of a 401k. It's called the terms of withdrawal. If the customer has been divorced in the past, they won't think of it, but we'll need the divorce decree, or if they're currently separated, we'll need the separation agreement. Also, what they won't think about a lot of times is paying alimony and child support. So we'll need those documents to show what the customer is paying. If the customer is collecting Social Security as their income, then there will not only be bank statements showing that Social Security being dropped into the account, but we'll also need an awards letter. If the customer has a trust agreement, we'll need a copy of that. And if they want to keep the house in the name of the trust, that's when we'll need a copy or a trust cert. Also bankruptcy documents. If they've gone bankrupt in the past, we'll need a copy of the discharge. And then if they own rental properties, check this out. We need a copy of the lease, and we need a copy of the tax bill, and we need a copy of the insurance deck page, and we need a copy of the loan statement on all rental properties to verify what those are costing the customer. So if he's got 10 rental properties, and we've done 10 rental properties, it adds up to be a lot of documents at the end of the day. Also business licenses, CPA letters, and if a customer has co-signed for say a brother to get a car, and the brother's making all the payments, we can remove that off the customer's liability, but I'm going to need proof that his brother has made the last 12 months of those payments. We can either do it with a bank statement showing the auto deposits being made to that car loan, or we can do it with checks if they're actually writing the physical checks. So those are the documents that are needed, and they, again, are not hard to get, but there can be a lot of them, and they do need to be updated as the transaction goes along. I'm just looking at my time. I probably spent more time on that than I realized. So I'm going to jump right into the loan process itself. Once the application is taken and those documents are gathered, then the loan officer is going to open up the application on his computer that the customer completed, and we're going to verify all of we'll verify the income, we'll verify the assets or the bank's statements. We'll go through the application, make sure every box that is supposed to be checked or filled out or completed is filled out, because any information missing in an application will just come back and haunt us. And the way I like to describe lending is this: if I put the train on the tracks properly, it will guide down the tracks properly. If I put the train on the tracks improperly and it goes off track, it is harder to get it back on track. So if you do it right the first time, then it makes everyone's life much easier. And that's why all loan officers should be really accurate and tight going into the transaction. We're going to look at the customer's reserves, which are his assets, to be able to determine how much down payment is going to be that the customer has the capacity to offer. And depending on the customer's assets or how much money he has, it's going to guide us to pick a loan program. So if the customer easily has and wants to put 25% down, then that makes it super simple for us to structure a 75% loan to value, 25% down loan purchase, and move forward. However, if the customer has very little money to put down, say, for example, 3.5%, or can muster up 3.5%, then we're going to look at an FHA loan. And we will have mortgage insurance on that, and we'll structure the loan accordingly. Once it's structured and ready to roll, and I've priced it out, and I know what our costs are and our payments, and the customer, it'll appear that they can meet the guidelines, then we will run it through what's called Fannie Mae's desktop underwriting, which is an automated underwriting system, or Freddie Mac's LP, loan prospector automated underwriting system. And we loan officers can run those, and I can run them within an hour of getting a full application and have a decision on that particular customer super easy. The problem is I have 10 people ahead of you, or I'm out in the field, or I'm not available at that particular time. And so it takes 4 or 5 hours, or then the following day. But the fact of the matter is it can be done in an hour. So if there is a rush, please let me know, and we'll drop everything and do the rush. If it can wait till later in the day, we can turn these very easily and very quickly. Once we have an AUS approval, which is the automated underwriting system approval, the file is now ready to go to processing. And that's where our processor comes into play. And the processor is going to do a whole lot of things that I don't do. It's backroom stuff. So they're going to pull the USPS link for the property address. They're going to verify the IDs. They're going to run data verify. They will be collecting the HOA documents if there are any. They'll do the Google 411, the company directories to verify employment. They will bucket, which just simply means they're going to take the documents, the financial documents that I've uploaded, they're going to put them in the proper buckets in the computer system. They'll prepare the 4506. They'll order the MI. They'll order the appraisal. They're going to do a lot of that background work for us to move the file from processing to underwriting. Now, underwriting is really quite fascinating because all they're doing is verifying the documents that we've uploaded. But they're also verifying the overall file to the they're verifying the overall file to the underwriters or to the guidelines. So Fannie Mae and Freddie Mac have what's called guidelines, and think of the guidelines as the rules to follow. So if the loan follows all the rules as the underwriter interprets it, then the loan approval slides through the system super easy. If there's a glitch, then we're going to need to go back and either write a letter of explanation as to why this is outside of the guidelines and it still makes sense to move forward, or we'll supply supporting documentation to get over whatever hurdle there might be that can be gotten over. From the underwriter, it's going to get approved, but it's going to be what's called a conditional approval. So when you hear that, congratulations, your loan is approved, what should be ultimately said to you is, congratulations, your loan is conditionally approved. And what a conditional approval means is your loan is approved, most definitely, provided we can meet the conditions in the approval. Does that make sense? So, for example, a condition could be you're missing page 3 of a bank statement. And we both know that we can easily get page 3. So that's really not a hurdle. But if a condition is you get a letter from the CPA stating that your accounts receivables can be, that you have a very low delinquency rate on your accounts receivables, when in fact you have a very high delinquency rate on your accounts receivables, and we're never going to get that letter from the CPA, then that would, even though your loan's conditionally approved, we can't meet that condition, your loan's going to die. So conditional approval, generally speaking, in our world is great news, provided we can meet all the conditions, and about 9.9% of the, or 9.9 times out of 10, we can meet the conditions. But there is an occasion where we simply can't. But we wouldn't know that until we've gotten that far into the transaction. Once we have met the conditions, they're uploaded back to the underwriter, who reviews the conditions, gives us the blessing to move forward, and issues what's called a clear to close. And clear to close is really the great news, because nothing's going to hold us up from funding that loan. From clear to close would be that we're going to order loan documents. And I've broken these steps down, hopefully for you to recognize that each of these steps takes time. Each time we go back to the underwriter, each time we make a new request for one of these milestones, it's going to take 24 hours to 48 hours or 36 hours, depending on the milestone and depending on how many files are in front of us. So if we're slammed, like in a refinance boom, then some of these could go a week. But if it's quieter, like it is today, some of these milestones can move in 2 hours. So what holds up lending is how many files are in the system. It's kind of like the Ford car manufacturing plant. Think of it that way. First you've got to get a frame, and then you've got to move it to the next department to get wheels, and the next department for engines, and you move it all the way through the line. Well, and then they have to be moved in the same path each time. But if there's a bog down, or if there's a delay because there's just too many things going on that'll slow that up, then our lending process slows up the same way. once we've gotten it to clear to close and we have ordered the loan documents, well, the first step is that the funder and the escrow officer today needs to get together to balance the closing disclosures. And the closing disclosures are the costs of the loan. So we have to make sure that the lender has all of their costs outlined in the lender's closing disclosure, and then the escrow officer or the escrow company has their costs, and we need to balance the two to make sure that we're to the penny at the end of the day. And once they balance, then we can release the loan documents to the escrow officer. But that little simple balancing act, it's taken sometimes up to 3 days, which kills us, but it's because not the funder's fault or the escrow's fault, it's the system. There's just not enough hours in the day to do the job that particular day. And so if we're slammed, again, that can take a couple days. Once the escrow officer receives the loan documents, then they are sent to a notary service. And the notary service now has to get a hold of the customer and set up an appointment. And then the notary will receive the docs, generally electronically. She'll print them out, or he'll print them out, and set that appointment with the customer, run out and get loan documents executed. And then they've got to get back to the lender prior to funding. So it's another day to get them overnighted or get them emailed, and we can fund on an email. We don't have to have the actual wet documents. Now, that entire process, we generally say takes 30 days. Do you need it done in 25 days? Not a problem. Do you need it done in 21 days? That's not a problem. I have actually closed a loan in 5 working days from start to finish. The loan application was taken on a Sunday. The entire package was uploaded, but it was done perfectly on Monday morning, and we funded on Friday. And the reason that occurred was because I leapfrogged everybody. And there was a reason for it, and you can get approvals to do those types of things. You're not going to get them done every month, and you're probably only going to get 1 or 2 of those a year. But if there's a reason for it, that's how fast you can actually close a loan. And that's with an appraisal. So any questions, comments, concerns on the process of getting it funded from start to finish? Bethan?
Jeffrey, can you see the Q&A box? If not, I can read those off to you.
Yeah, read them off if you could, please.
Sure. So one question from Amanda: can we get a list of people involved in real estate transaction?
Sure. Mm-hmm. I will, I have it here printed out. I'll copy and paste it. And Elsie, should I put my email address in there and she can email me directly and I can send it to her, or?
Yeah, if you'd like to do that, you can also send it over to me, and we will, because we're sending a copy of the recording out to everybody, so we can also include it in that mass email.
Okay, I'll do that. I'll have to prepare it, but it super easy to do.
Okay, and
next
then,
question.
How does cryptocurrency fit in?
Cryptocurrency fits in perfectly. Just liquidate it, put it into a checking account or a savings account, and then we can use it. But we can't use it directly. Like, I can't accept Bitcoin. Nobody can, really. It's coming, but right now it's not acceptable. But liquidate it and then it's acceptable.
Okay, and then from Michael, can you please recap what is the process steps once the loan officer sends the documents to the notary?
Of course. So it's actually the funder that the lender's funder that actually prepares the loan documents and sends them to the notary. Or well, actually sends them to the escrow officer. So the funder and the escrow officer balance out their CDs. So the math is correct on both sets of closing disclosures. Then the funder sends to the escrow officer a set of blank loan documents for the customer to sign. And then the escrow officer will have a notary service that they hire, third-party vendor in most cases. And the escrow officer will email the notary officer those documents once the notary is signed and they know who's going to be the person that will go out and meet with the customer. And the notary will take those documents with them out to the customer and sign them. Now, you're going to be seeing, particularly today going forward, a lot more electronic signatures on these loan documents because they're rolling it out as we speak. But there will still be 4 or 5 wet signatures that are going to be required. And so therefore the notary service is still in play right now. But there will be one day when it's all electronic and no notary needed, and the customer can sign the documents at their leisure whenever they want. But right now there are still wet signatures that are required, and but we've cut them way down. Instead of signing 50 pages, they're signing 6 or 7 pages of wet signatures. We're located in Tustin, Orange County, but just so you know, all loan officers that are licensed in California through the NMLS can do a loan in any city in California. So I have customers in San Francisco, I have customers in San Diego, I have customers out in Riverside and in Palm Springs. So anywhere in the state is where we can originate.
A couple more questions from Jose. What is the best thing to do when a borrower has a high car payment, $600 to $700 plus? Is it better to refinance it or put it into someone else's name?
Well, is it better is kind of the interesting question. If you put it into somebody else's name, 100% of the car payment, then of course, the person that has the debt on the car is going to also want to be on the title of the car. So there's that issue. But it does, if you put it in somebody else's name, remove 100% of that debt. So the car loan goes to 0. So from a qualifying standpoint, the less consumer debt you have, the less car loans or the less credit card loans or medical payment loans or whatever you've got on your credit report, the less that you have of that, the more you have that could be contributed to a home loan. And so if the customer has a $600 a month car payment and you can cut it by $300 by refinancing it, then that frees up $300 for the home payment. So ideally, if you have 0 consumer payments, you can maximize your home purchase. But if you've got 4 car payments and 60 grand in credit card debt and student loans and a medical bill or 2 that you're paying off still and whatever, it just crushes your income. And so the less debt you have, the more you can afford to buy from a house.
Okay, and then one more to go back to the cryptocurrency question. Can those assets be considered if non-liquid asset if someone isn't wanting to liquidate?
No. Sorry, not there yet.
Okay, and I see one in the chat. Can you see that one from Marla?
Let's see. Mark, what city am I in? Amanda. Marla. Okay. Regarding switching auto loan, would you would you require a timeline? Promise not to move it back so that once the car loan is done, you won't switch the car loan. Okay, so here, that's, you know, I get where you're going with it. So here's the deal on debt. Anything that shows up on your credit report that has a monthly payment is called a liability, and it's an obligation that you make every month. If you can figure out a way for that to disappear, then we can close the loan without it, and there are no checks and balances afterwards. So if, for example, they went to their rich uncle and said, I need 15 grand to pay off my car loan, and I'll give you the 15 grand back after I close my house loan. You get the 15 grand from your rich uncle, you pay off your car. We do a credit supplement on your credit report to show that the car's paid to zero. We remove that liability. You can afford the house. You close on the house and you're done. Okay, washed hands. Then if you choose, or the customer chooses, to go get another car loan and pay his rich uncle back 15 grand, there's nothing the lender can do about that. That's outside of the transaction after the fact. We can only lend on what we see when we see it. Does that make sense? For example, the value of the house, that's a good one. We lend on today's current value. Well, 15 years ago, the values were one number, a lot lower, and today they are super high. But we're lending on those super high values because that's what it is. Now, could it drop in the future? Could those values way back down, and could houses be underwater in the future? Absolutely. But the loan is structured on your current income for the last 30 days. For example, if you got a raise last month and you're making an extra $1,000 a month, that's good because that's today. If your debts all got wiped off your credit report because you have a rich uncle and they're off your credit report, that's good. We're lending off today, what we see today. If all those debts get piled back on after you buy the house, there's nothing we can do about it, nor are there any checks and balances stopping you from doing that. Okay, did that help? Okay, great. And feel free to email me side questions after the fact.
There are a few more questions, but let me know how you are with time.
Okay. Oh, I've got as much time as everyone's got. I have another section that's super important, so don't leave because this is the meat of the show coming up. Okay. Which part of the loan processing steps that you covered are the most at risk and potential to kill a loan? Okay, great question, Michael. You know, most customers are honest and they tell us what their income is, but sometimes they forget their expenses. So a realtor will tell me I make $150,000 a year. But when I get his tax returns, he's expensed $60,000 in expenses for his car, for his home computer or home use. He's expensed signs, open house, catering events. He's expensed some movies, marketing, because all of us want to pay less taxes. And so we're aggressive on our expenses. So the fact of the matter is I thought you said you made 150 grand a year, but in fact you make 90 grand a year at the end of the day. The truth of it, that's what we can qualify you on. So that's a big risk. Assets, you know, generally speaking, most people know how much they've got in the bank. Gift money, we can use gifts as part of the down payment and as part of your asset reserves in some cases, not all. And we'll get on occasion where like dad's going to give me 50 grand for the down payment. Not a problem. I'll get 50 grand. And then when push comes to shove, dad says, no, I said 25 grand. And so you're starting over there. Let's see what else. We've had people get fired in the middle of a transaction, and now you can't verify income. That's a risk that blew a deal. I had a customer die, but that's very uncommon, but it happens. The Orange County bankruptcy many years ago, that was a risk where a lot of people pulled out of transactions. The best thing I can tell realtors and agents would be this. When working with buyers, limit yourself to working with buyers that have been pre-approved or pre-qualified. And what I mean by that is have them fill out the application with a lender, get the documents in, and get that pre-approval tight. Now, I can listen on the phone to an attorney or a CPA or a doctor, and he can tell me what he makes, and he tell me how much cash is in his accounts, and he's pretty confident and savvy and understandable, and he's got it down. And I can say, okay, yeah, you're going to be good to go for the transaction that you want to do pretty easily. Where it gets hard, to be honest with you, is when you've got, like myself and my wife, we make enough money to survive in Orange County, but if we want to move up, we've got 2 car payments, and our ratios will be tight to move up. We might need more down payment that we don't have, or we might need a lower loan amount, but the tighter the loan, where that debt to income ratio is right on the verge of blowing, that's where it gets pretty risky. And sometimes, nurses or overtime people, drilling rig people, oil patch people, when they have a lot of overtime, sometimes they think they make more than they actually make, because those overtime money, it's a 24-month average. And so they've made it for the last 3 months. And so they think they'll qualify on it, but they won't. So there's those problems that can occur. What else?
I think he meant to say, do collections have to be paid?
It depends. So Fannie Mae and Freddie Mac have what's called automated underwriting engines. And these are computers that have algorithms that make the decisions for us. We see collections have to be paid in certain circumstances, and we see collections that don't have to be paid in certain circumstances. So there's not a broad brush yes or no on that question. It's a great question. And that's why it's so super confusing for consumers as well as realtors to understand. Mary gets away with this, but Tom doesn't get away with it. And the reason is because the algorithms in the computer systems are built to reduce the risk. So if Mary's FICO score is 800 and she's got 500,000 cash in the bank and she's only borrowing 60% loan to value, they're going to let her collection go because she's a pretty low risk deal. But if the Tom is at a 3.5% down payment only, and he's got a 640 credit score, and he's got, no cash reserves, then he's a much higher risk. And they may say, oh, let's get that collection paid off. So we just have to run it through the computer. When switching jobs, same industry, do they need to qualify with the new pay? Yes, you can most definitely qualify with the new pay increase with a new job, but you need 30 days of pay stubs showing that. So that's your catch. So the guy comes in and he says, hey, I'm now making $75,000 a year. Let's close on this house. And I'm like, well, I need 2 bank statements, 2 pay stubs or 4 pay stubs showing that 75,000. Then we can close. Okay. Okay.
I have a couple more in the Q&A.
You bet. Remember, we have a class tomorrow. So if they did not sign up, they should sign up today before 2 reminders. Okay. Good.
How much do business expenses affect loan eligibility?
Oh, significantly. This is why. If you make 100 grand a year and your business expenses are 50 grand a year, you've only made 50. So I can only qualify, or any lender will only qualify you on the income that you made, which is 50,000. But if you made 100 grand this year and your expenses were only 10 grand, then we're qualifying you off the remaining $90,000 of income. So it's business expenses significant. It's a really catch-22, because you and I don't want to pay the IRS any extra money. So we're going to front load our expenses as heavy as we can, but it hurts our ability to borrow money.
Okay, and then would you request a gift? I'm not sure if you answered this one already. Would you request a gift letter from the uncle for the money to pay off the car? Would not, I think she meant, if not, the lender,
yes.
Would not the lender want to know where the money came from to pay off the car?
No, a gift letter is perfect. Yep. Anytime we're introducing money, big money, like 15 grand, into a transaction that's showing up on an account that we see, will require an explanation. If the uncle made the gift 90 days ago and it's not showing up today on the last 60 days of bank statements, then we never knew it occurred. So it's also a timing game. So if I know I'm going to get a loan personally in September, and I'm actually giving you a legitimate scenario, I know I'm getting a loan in September for a new house, I need to wipe off some debt today so it doesn't show up on my application in August. And it's easy to do. So I'm going to be knocking down debt here so it doesn't show up in August when they run my credit. So in September, when I get qualified, I won't have that problem. So yeah, gift letter, perfect. Did the interest rate increase cause many borrowers to not be qualified anymore? Oh yeah. Think of it this way. A consumer can only borrow as much debt as his income can support. So if the debt on a house jumps from, if the PITI, which is principal, interest, taxes, and insurance, if that jumps from 2,000 to 3,000, but his income hasn't changed, then he may not qualify for that $3,000 a month payment. Those are low numbers, but if I used it from 5,000 to 7,000 a month, maybe that's more in your wheelhouse. But yeah, the interest rate increase has hurt borrowers from borrowing on the debt, because the payments are higher and it just erodes, and incomes don't go up as fast. Our interest rates jumped basically from 3.5 to 6 in 60 days. So it has definitely had an effect. But there's a trick around that, and it's called a buy down. And it's not planned to go into it right now, but you can pay points from your rich uncle who's going to lend you the money to buy the interest rate down. So you can buy it down from a 6 to a 5, or you can even buy it down a 3, 2, 1. So you can buy it down to 4 for a year or two. It'll eventually go back to market, but it'll squeeze you into the house today. Shoehorn you into the house today. Okay, what's next? What else, Elsa? Anything?
One more I see here. What about using an ARM loan for a lower rate?
Yeah, all day long. There's an explosion in arms right this very instant, and I also see there's an interest-only question, and I'm going to go into interest-only in this next presentation if people have time. I've got 5 minutes left to 2. You guys vote on what you want to do. I can take this to 1:30 pretty easy, or
2:30, you mean?
That's what I meant. 2:30. My bad. My bad.
Yeah, I think you can. I don't see any more in the Q&A, so we can go ahead and have.
Okay, here's a question. How much can we buy down? I will get you an answer on that. Shoot me an email if you would. There's a 3-2-1 buy down, which means you can actually buy 3% down. It gets pretty expensive. We usually play in the realm of a 2-to-1 buy down, but I'll get you that and get you a solid answer. But yes, we can buy down. The interest-only loan is not a bad loan also, and that's because your payments are less, but that's if the lender will qualify you on the interest-only payments, when sometimes the guidelines make you get qualified still on the principal plus interest payments. So it's a wash then if it's a qualification question. What else? Okay, you guys jump in on anything else you want to know and I'll hit it. But we're going to jump into this last section because this is the meat of this section, and I get really excited about this. I love this piece of this lending. So there are 3 silos of loans today, and I just think it's super imperative that you guys all understand these silos crystal clear, because by you understanding these silos, you'll understand if this customer is a legit deal or not. And that's what you want to do as a realtor. You want to identify if the customer is legit, ready, willing, and capable of buying in the next 90 days. Otherwise, you're spinning your wheels, particularly if you're with the looky-loo that's dragging you on, or the one that tells you he can buy a $1.5 million house when he can't really afford an $800,000 house. So these 3 loan silos are where any customer is going to play in. So silo number 1, think of it as a tax return loan. Think of it as you have to verify everything. Silo number 1. So you have Fannie Mae, Freddie Mac. Those are your conforming loans. 9 out of 10 times you'll need tax returns, but as I said, in an automated underwriting computer, sometimes they don't require tax returns, but they will always require pay stubs and W-2s or 1099s. And jumbo loans. So in silo 1, there's 2 products, but 3 vendors. There's your Fannie Mae vendor loan, Freddie Mac vendor loan, both conforming and high balance conforming, and then jumbo lending. They will always require tax returns, and these are called qualified mortgages, because what came out of the 2007 and 2008 mortgage market meltdown was by 2015, the TRID laws came into play. And the TRID laws specifically are to protect the consumer. And so they made it the responsibility of the lender to make sure the customer had the ability to repay. And the easiest way to figure out the customer's ability to repay are with tax returns. So silo number 1, tax returns. Silo number 2 is super cool because Wall Street said, what if the guy can't show his tax returns? What is another way to prove ability to repay? What is another way for me to stay within the laws of lending, but not require tax returns? So clever Wall Street says, if I pick up 12 months of bank statements or 24 months of bank statements and I look at all your deposits, I can count that as income, and that shows me your ability to repay. These loans are called non-QM loans. They are non-qualified mortgages. So if I go back to the qualified mortgages, Fannie, Freddie, Jumbo, that require the ability to repay with tax returns, there's a handful of things you can't do in that group. I'm backtracking a little bit, sorry. You can't do interest only. You can't do a negative amortization loan. You can't add a prepayment penalty. You cannot have a balloon payment. There's no loans over 30 years. And there's a maximum limit on your debt to income ratio to stay within guidelines, to stay within the ability to repay. But Wall Street looks at, has a second silo of loans that can do all that. And they do it based on the ability to repay in a different way. So they don't need pay stubs, they don't need 1099s, they don't need W-2s. They're going to look at a different way to show the ability to repay. So 12 months of bank statements, 24 months of bank statements. There is a lender out there that's doing 3 months of bank statements. Pretty cool. There is another bucket within that loan that will not require tax returns, but they want to see your 1099s. And we do a lot of realtor business on this, because if you show me your 1099 and it's 100 grand a year, I can qualify you on 100 grand a year because I'm not asking you for your tax returns. So I'm not seeing your expenses. If your 1099 says 100 grand a year, the lender says you make 100 grand a year. Let's go roll with it. Another way is to divide a big bank account by 10 years, 120 months, and come up with a payment. So if you're rich, or the customer is rich and let's say has a $2 million bank account somewhere, we can divide that by 120 months and use that number as income to repay the loan. And there's a lender out there that'll do it for 60 months, 5 years. Just doubled your income just like that. Or, you know, retired people fall in that bucket too. You know, their tax returns show they make 38,000 last year, but they got $1.1 million loan. Well, how's that happen? Well, it's because they're retired now. So the retired guy that's got 2 million in the bank, 3 million in the bank, all of a sudden can qualify for a loan. There is the ability to mix and match income with the non-QMs. So we can use rental income, we can use their Social Security income, we can throw in child support if I can verify it, that they've collected it for 12 months, and we can do asset depletion all in one loan. All showing the ability to repay the loan and legal. And it's not stated. And they're solid loans. I mean, don't get me. If you think that this is anywhere near what had occurred back in 2004, 5, 6, and 7 with the mortgage market meltdown, the answer is no, it is not. This is nowhere near that. This is actually still figuring out a way to show that the consumer has the ability to make the payments. So this non-QM loan is really good. This is a killer loan. I do a lot of these loans. It's called DSCR, Debt Service Coverage Ratio. It is only for an investor. So if you own a home and you want to go buy another home, but you don't have your tax returns to support it, then we can use the income off this new rental property that you're going to buy to qualify you for it. So DSCR loans for investors buying an investment property, we're going to use the future predicted income based off the appraisal for qualifying purposes. And it's an easy loan, super easy loan to do. And this loan also has interest only. This loan also has a 40-year amortization program, or a 40-year term, and it's killer because it really lowers those payments. And the customer's not going to keep the loan for 40 years anyway. The average life of a loan is 8 years. Used to be 4 years, but it's kind of gone up over the years, and it's going to probably go up even higher because we've had such low interest rates. And these loans have prepayment penalties. So you're going to want to keep it at least 3 years prior to paying it off. Otherwise, you're going to pay a prepayment penalty. But don't let prepayment penalties discourage you, and don't let prepayment penalties worry you. Because if you have to give back 1% of the loan amount, though it stings, it's not the end of the world. Last year alone, houses increased 17%. So if you've got to give back 1% of that, okay, it's all in perspective at the end of the day. Now, there is a, those are your first two loan silos or loan to choose from for a consumer. This last one is super cool. Check this out. The United States government wants all consumers that have good credit, fair credit, and a down payment to own a home. So if a consumer cannot qualify for silo number 1 or silo number 2, the government still wants you to have access to financing so you can buy a home or refinance a home or get cash out of a home. The government wants parity for all Americans from coast to coast. They do not want everybody. They know that W-2 employees with tax returns can easily get a loan. Wall Street has ensured that if you don't have tax returns, there's 4 or 5 different ways you can still get a loan. But if you don't fit those two silos, this last silo is I call it a bailout loan. And it's designed for any person that wants to buy a house that doesn't qualify for these two first prior silos. They can still get a loan. And this is all you need to qualify. And I'm going to make you the underwriter right now. Write these 2 things down. You need a 640 credit score, and you need a minimum of 20% down, and I can get you a loan. 640 FICO, 20% down payment. You are now an underwriter for what's called a community loan. A community loan falls under the United States Treasury Department. It's a government loan. It is not smoke and mirrors. It's available to everybody, and I do them with ease. So, but you need a down payment, and the down payment can be gifted, and you need at least 20% equity in the home. 25% equity in the home is better from a pricing standpoint. And the higher your credit scores, the better the pricing. So I just saw something pop up. What does DSCR stand for? Okay, so that's going back to non-qualified loans. This goes back to silo number 2. It's an investor loan, and it's underwritten off of the rental income. And DSCR stands for debt service coverage ratio. Coverage, debt service, DTI. So what they'll do is they're going to look at the rental income. They're going to subtract the loan payment. they're going to subtract the taxes, they're going to subtract any HOA, and they're going to subtract the fire insurance policy. And it's going to give us, well, I'm sorry, we're going to actually add those up, and we're going to divide it by the rental income, the monthly rental income, and that will come out to be a ratio. And it's like it'll be a 1 or a 1.25 or a 0.90 or whatever the ratio is, debt service coverage ratio, and that's how they lend against it. If it's 1, it's 1-to-1. It covers the rents, cover the expenses. Therefore, you qualify. You've shown ability to repay. Therefore, you get the loan. Of course, you are welcome.
There's a question in the Q&A here. If husband and wife were looking to buy home, but husband is W-2, wife is business owner with large expenses, would it be better if husband solely qualified separately and add wife name to title later?
Okay, that's a good question. See, why that's hard to answer is because I don't know how much debt the customer wants or how expensive of a house do you want. And the reason, I mean, the answer is yes and no, depending on the perspective that you look at this transaction at. And what I mean by that is, yes, the wife's expenses will hurt the wife's income. It will drop it, so she can't qualify for as much. But let's say she makes $24,000 at the end of the year. Well, maybe that $24,000 is just enough to buy the house that they want, to be able to afford the debt that they want. So in this case, the husband would want to keep the wife on the loan. But if the wife's income is such, if it's a negative and it's going to draw upon the husband's income, then most definitely take her off. But then you can only qualify for a house based on the husband's income. So if the husband makes $100,000 a year, he's gonna have to pay both car payments and all the credit card debt and all the student loans and all the medical bills and whatever's on the credit report. It's going to come off of his $100,000 with no support from the wife. And then he can qualify for what he qualifies for. And if there's 0 on his credit report, that's beautiful, because then he's got a lot of money left over for the house. But if he needed the wife's, if she was making even $10,000 at the end of the day is almost $1,000 a month, $800 a month, that $800 a month might be just enough to get him over to the hurdle to buy the $900,000 house instead of the $800,000 house. Okay, we pick it up tomorrow, everyone. Oh, how many years of income does a 1099 need to show? Generally speaking, a 1099 is a self-employed person, so they're going to want to see 2 years. 2 is kind of the magic number. There are times when I'll pick up 3 or 4 years, and I'll tell you why. If the customer can show an erratic income spike, income drop, income spike, income drop, then I might even go back 5 or 6 years. And I had this example, 1099 attorney, but he was an attorney that was paid on the cases that he won. So his cases would drag on 2 or 3 years, but then he would make a $600,000 hit. And then he might not make income for a year. And so in that guy's case, I went back further, but for the normal realtor or the normal salesman that's on 1099, 2 years is sufficient. So I just popped my email back in there. Feel free to text scenarios, questions, whatever. We'll pick it up tomorrow at 1 o'clock. And thank you all.